Hey, I'm Erin Milstead with CMG Home Loans here with Dave Herbst. He is the pioneer of the all-in-one program here. We're here to discuss the ins and outs of it, how it works, who it most would benefit. So Dave, go ahead and give us the 101 on it.
Erin, good to see you.
You too.
So the all-in-one loan, as you know, is an extraordinary program that we've had available since 2005, originally under a different brand name called the Home Ownership Accelerator, a 9-syllable name for a mortgage. Seems a little overkill.
Very long, yes.
Yeah. And a lot of people weren't able to spell the word accelerator accurately, unfortunately. I make fun of that. It's actually partly true. We rebranded the product name in about 2010 to the all-in-one loan, which is what it's known as today. And it's an extraordinary program. It's a mortgage product, proprietary to us, CMG Financial, CMG Home Loans. What makes it so different is that it merges together home financing and personal banking into one financial hub. And I know that's a shift in thinking for a lot of people. I'm sure a lot of people are like, what? How does that work? And it's personal banking. By personal banking, I mean a checking account. And this makes a lot of sense because checking accounts are typically where we flow our income to and pay our bills from, including a mortgage. Well, it sort of seems like we're delaying the process of repayment with our mortgage and equity buildup when we isolate our earnings from our debt. The all-in-one loan changes that completely simply by linking them together into one financial hub. So a checking account gets integrated with the mortgage, allowing income, any deposit whatsoever. It could be $1, it could be your income check, it could be your savings, to flow directly to your mortgage principal to lower what you owe, in which interest is being charged. The whole idea behind the loan is to keep money liquid that you earn through an instrument you're already proficient at using, a checking account, to automatically offset the cost of your home loan. And it's an extraordinary benefit because it lowers what you have to pay for your home without relying on lower interest rates. So whether rates are low or high, it can save people a significant amount of money.
Huge amount. Sounds like a very strategic approach. And
Mm-hmm.
I know I've used this all-in-one with many of my clients and referral partners, actually. I just had a referral partner text me this last week. Said, hey, Erin, we've paid down $50,000 already, and they've had this all-in-one for less than a year.
Yeah.
So $50,000 off of principal, which is insane.
It's not uncommon. Tens of thousands of dollars in principal reduction are realized annually by the typical customer. And that's again, without any change to their budget. We're just taking what
Right.
people would typically budget for regular expenses and using the entirety of their paycheck, money that would normally flow through a standard checking account, and flow it through this one. And the difference is, instead of allowing those dollars to reside, idly, sort of unemployed inside of a checking account, earning us very
Stale
little
cash.
interest,
Yeah,
right?
exactly.
We allow those dollars to flow automatically that very day against the mortgage principal balance, which lowers interest cost automatically. And so people spend their money like normal. The loan comes with ATM debit Visa cards, online banking, mobile banking, bill pay, direct deposit, check imaging deposits, ACH, wire transfers, all the payment processing systems like Zelle and PayPal and Venmo that you're accustomed to, and check writing, of course. You just spend your money from your mortgage using the linked checking account, and it draws or drafts those dollars automatically, no manual movement of money.
That's the nice thing. It's forced savings.
That's right. It
Because
does.
I've in the past had a HELOC and kind of done the same thing where I use the HELOC as an emergency account or front some things and then
Sure.
recoup that. You've always got to keep a little cushion in your checking,
That's
So I love the idea of the sweep every night at midnight,
Every
comes
night.
over and takes care of that,
And
pounds down that principal.
I would say the cylinder within the engine that drives it all is the interest calculation. How interest is calculated and charged matters. Of course it does, right? So instead of being amortized, because that is the most expensive part of a mortgage, is the amortization schedule.
Oh my gosh, yeah. I have a amortization table that I share with clients when I'm talking about this all-in-one. 78% at current rate today, 78% of your payments over 30 years will go towards interest.
That's right. That's right.
Insanity.
And people recycle the debt pretty routinely too. So they get stuck in that rut, that interest rut, right, of paying mostly interest within their mortgage payments each month and making very little progress on principal reduction. Now, what does principal reduction stand for? It reflects equity gain, right? Because it's the same. If you reduce what you owe on your mortgage, then you have also gained equity in the property, which is a good thing. And the extraordinary part about the all-in-one loan is that it keeps that money liquid. And cash isn't king, liquidity is king. If you can create
Definitely.
greater liquidity, resourcefulness, it allows you to have an easier time maneuvering through life.
Mhm. And jump on those investment opportunities when they come up.
That's
You've
right.
got access immediately.
Or challenges, right?
Exactly.
And imagine, your hot water heater breaks, or maybe your roof needs replaced, or you need to supplement the cost of college tuition for a child, et cetera. Instead of tapping into your investments, your 401k, your stocks.
Exactly. It evaporates the need to finance.
That's right.
Do cash out, incur extra fees, or
That's
a HELOC or something like that. You've already got access. So
now the home can serve as what's called a buffer asset, right? And preserve retirement funds, right? From those challenges, those routine things, those curveballs that were thrown, fairly routinely.
I love it. I absolutely love it. This is completely transformative. I know and I love the versatility. Like we spoke before earlier, I'm going to use this as my next investment property purchase, but it's so versatile. You can use it on a primary, a second home, an investment property purchase, refinance. There's so much control that the consumer has.
And construction. So a custom, semi-custom home. Yeah, you can essentially build a brand new home using this. And, for everybody's benefit, the mortgage side of the all-in loan is a first lien position, 30-year draw line of credit. And that's what creates the open-end nature, the fluidity of money flowing in against principal, but keeping that money liquid for use on a daily basis, keeping that money available 24/7. And the way you use that money is just simply by using the checking account. You swipe your ATM debit Visa card at maybe the gas pump or the grocery store, or write a check for a down payment, or to fund the construction of an ADU in your backyard to start cash flowing that way, whatever it may be.
It's great. Yeah.
Money comes right out of the line of credit, out of your home, and allows you to fund those without having to go get more liens or tap into assets.
Incur costs. Exactly.
That's right. It's an extraordinary product. The typical customer also pays down their balance about 2 to 4 times faster just by using their current budget. I help educate people on this. I don't think we think too deeply about the activity that's going on our checking account. I think most people just walk around thinking, my income is already spoken for, even though they haven't spent their money yet. They've got a utility bill, they've got their cell phone bill to pay for, they got groceries, they got other things, car payments, credit cards. That's right.
And how it's deployed.
That's
exactly.
right. On any given day in the United States, there's about $14 trillion sitting there idly, lazily, sitting in either checking accounts, savings accounts, money market accounts. And that's a lot of money, right? People have money to spend. It's sort of spoken for psychologically in our minds already. It's earmarked. Well, what good is money just sitting around earning you very little interest, near zero, right? A lot less interest is paid out on our earnings than we have to pay out on our debts, right? So the idea behind the all-in-one loan is, let's give that money a job. Let's just give it a job. Let's transfer it from, essentially being unemployed to employing that money. And here's the coolest thing about it is that a dollar saved in interest cost is the equivalent in terms of net worth gain as interest gained. So if you spend $1 on an investment and you gain interest on that, which is taxable, by the way, right, as income. And if you instead took that same dollar and you put it inside the all-in-one loan to save interest, it's the equivalent net worth gain without the tax implication. You don't pay taxes, income tax, on savings that you incur by avoiding interest. That's what makes it so fundamentally different.
And it just moves that lever. It leverages more, faster. When I run these scenarios, typically it's a 5 to 7 year period on clients that I usually run the scenarios for. And the APR on it usually is less than 2%.
That's right.
Usually, not always, but usually.
The effective comparison interest rate. That's right. What if you could save so much interest? It's the equivalent of getting a mortgage below 3% today. That's standard, right? Without having to wait for rates to come down to 3% or 2.5% or even 2%. Because that may never happen in our lifetime again, right?
It's wild.
Well, I'll tell you how you do that. You get an all-in-one loan. It's principal paid first, interest recalculated daily, monthly interest payments recast automatically down with principal. The whole point is zero, right? Wouldn't you like to drive your payments to zero sooner in your life?
Of course.
So instead of paying the same payment all throughout a mortgage term, this drives it down. I call it a rewards-based mortgage. You're rewarded by a reduction in your payments just by using it.
And you've still got access.
You still have access. Your money's
the
liquid.
dual cool part about it.
That's right.
So
I think without the access, it would make it risky, right? And so this eliminates the risk or doesn't increase risk to a financial profile because all that money you apply towards it remains liquid.
I love it. I love it. Well, thank you so much for joining me here today, Dave. Looking forward to many more of these with you.
Thanks for having me, Aaron.
Yeah.
Absolutely.